Good morning and welcome from the Senior Law Day Collaborative. My name is Melinda Bellis and I'm an attorney in charge at Legal Services of the Hudson Valley. I'm also a co-chair of the Senior Law Day Collaborative. I share this role with Elena Falcone from the Westchester Library System and Sarah Steckler of Warshore Burstein. We're also ably assisted today by Bruce Siegel of Marketing Sense. You've joined us today to learn about how tax planning changes through 4 stages of retirement. But first, let me tell you a little bit about the collaborative and the resources available to you. The collaborative is composed of more than 150 professionals who are all eager to bring authoritative information on legal, financial, and health topics to our county's older adults. We make available educational workshops throughout the year, as well as brief one-on-one consultations with collaborative professionals. You can connect with our resources and services through our website, seniorlawday.info. The site is a resource for information on legal and financial topics addressed by the collaborative. In fact, you can go there to watch the video recordings of prior webinars, access printed reference materials such as our annual updated and excellent elder law Q&A, and send us your questions on any topic of concern to older adults. Just look for the Ask Us button on the site. Send us your contact information and a rough outline of your question. We will work promptly to connect you with the needed expertise. Before we turn to today's presenter, I would just like to tell you about a very special program that's coming up. As I just mentioned, the Senior Law Day Collaborative offers one-on-one consultations throughout the year, and we're planning to offer these consultations next week on May 12th. This is an opportunity to have a free consultation with an attorney, financial planner, or care manager. So if you have any questions, I urge you to visit the seniorlawday.info website and register to speak to one of our professionals. Registration opens up on May 11th at noon. The consultations will be assigned on a first-come, first-served basis, and once all appointment slots have been filled, registration will be closed. So please sign up early if you're interested in having a consultation. In addition, if you have any questions or would like a personal reminder, Bruce will put his email in the chat. Just contact him and he will respond to any questions or give you that reminder. And now a few points about the format in which we're working today. This Zoom video conferencing event is being recorded with the aim of posting the recording to the Senior Law Day site. You as participants are muted. However, you can ask questions via the Q&A box on the bottom of your Zoom window. We may not be able to answer all questions that are posted, but unless you choose to ask anonymously, we'll work to follow up via email. And you can also save your question for that Ask Us button on the seniorlawday.info website. Now I'll turn this presentation over to today's presenter, Jean Riordan, Certified Financial Planner and Vice President of LEXCO Wealth Management.
Good morning. Thank you, Melinda. Thank you, Bruce. So good morning, folks. So I think we have some exciting tax info for you today. So I'm going to go ahead and just jump right in and get started. And when I share the screen, we always start with a tax brain teaser. So I'm going to challenge you folks to take a look and see what you think before we go right to solutions. Give me one sec. Okay, so hopefully all folks can see this now, and we'll go from there. So to start out today, we're going to talk about why we're here. And so why we're here is that as our life changes and we progress in our natural aging, different taxes come and go into our life. So in order to show you that and give you examples of that, I went through some real life cases that we were surprised to find as clients made choices with their cash flow, how it played out on their tax return. So with that being said, I'm going to start with the first one, which this has to do with Social Security. So this gives an example of a client named Bill who was retired already. He clearly was in a 22% tax bracket over here because his taxable income is $42,000. So no big trick there, okay? Within that taxable income, he had $38,000 of IRA income and $25,000 of his Social Security benefits. So an average person. He decides, though, to splurge and go out for a concert road trip. Let's say Willie Nelson, for argument's sake. That shows my age, but let's go with that. So he splurges and takes $1,000 out of his IRA to go on this Willie Nelson road trip to see this concert. Okay. So what happens? So now at this point, you should all be thinking, an extra 1,000. We go over here, clearly shows us he doesn't leave the 22% federal tax bracket. But let's see what really happens. So in the end, we're thinking that he's only going to pay 22 cents on every extra dollar, correct? Therefore, he should owe about $220. So he probably anticipated, I'm going to take $1,000 out of the IRA. This is what should happen. What really happens? Wrong. So what really happens is the end result, the total result on his taxable income is $407. So he withdrew $1,000 and paid a price of $407, which maybe that's still a good choice. But for my job as a financial planner, we want to make sure he was aware in advance that it wasn't 22%, that it was really more like 40%. Now, I spent a lot of time doing these types of webinars and presentations with folks. So a lot of people take out their pencil and will be grinding on this. It is a tough one to understand. We're going to come back to it in a little bit. So I just wanted to open up with why this is important. And I also wanted to stress, like, this conversation isn't just for wealthy people or, people or lower incomes. This kind of, there's changes in our tax code, and there's implications of decisions with our cash flow that impact all of us, all across the spectrum, different ranges of wealth or income. So again, hopefully I chose something very simple and a simple income rate just to let you all know that it does affect everybody. Okay, so my name is Jeannie Riordan. I've been in this industry, unfortunately, 31 years now. Fortunately, because I've had a lot of great experience that I've learned from and hopefully helped clients learn from. So the name of this presentation is How Tax Planning Changes Through 4 Stages of Retirement. So what we found is that we I read somewhere that the cute way of looking at retirement is there's 4 different stages. One is called the go-go years, is the early years, then the slow-go years, then the no-go years later on. So we're going to look at this in depth. But again, as we ease into retirement and enjoy our retirement years, enjoy our lives, different taxes come out at us at different times. So we're going to talk about that. Before I go to that, though, I'm supposed to just do a formal disclosure to tell you that anything that's discussed here, in the end, you may want to seek professional tax guidance. Don't use what I'm giving you some examples of what's happened with other folks. Again, everybody's situation is unique, and you want to discuss it with your financial planner. Maybe you have an investment person. Maybe you have a tax professional that knows you and that you've used for years. So the moral of the story here is I'm trying to give you some language and some scenarios just to make you more aware of the big picture. To drill it down to your specific picture, you really want to get with a planner that knows your situation. It starts with usually assessing your own tax return, your 1040, looking at your personalized source of cash flow. So what's going on? We've had sweeping changes in the tax system in the last couple of years. With the changes in administration came changes in the tax code. Some of the changes, quite honestly, we hadn't seen this level of changes in 30 years. Like 1988 was the last set of big tax changes. So as you folks recall, in 2018, we took the whole tax code and we turned it upside down, I feel like. So we doubled the standard deduction. We took away a lot of possible itemized deductions. That year, I've had the most tax planning questions I've seen in years. So we're pretty good as citizens. We get trained in how to do things. We like to keep it neat and tidy. We keep our receipts over here. We know what the accountant's going to ask us for. We like to present and get our tax returns done. Unfortunately, in 2018, a lot of things were shaken up. Good or bad, depends on your tax situation. And besides that, as we age, we lose things like the child tax credit. Maybe, hopefully, your mortgage gets closer to paid off, and you're losing the mortgage interest deduction. I don't have to talk about the SALT tax. Everybody knows the cap was put on at 10,000. That affected a lot of folks, especially in the Westchester area. What else? So just things that we had going for us, maybe as employees or parents, as we age, those items that were favorable and that we were used to using because we had years of training to get there. Those items have been put aside. The things that are new is your income may come from Social Security now. As you turn age 72, you have RMDs, which are forced distributions from IRA accounts. So even though you might not need money from your IRA accounts to live on, maybe you're doing okay with your investments, with pensions, with your spouse's Social Security, whatever your situation is. But what happened is this required minimum distribution, for those of you that are not familiar, pretty much the government said, hey, Jean could live to 100 and she might not need her retirement dollars. And we've been waiting for our tax share. So what they did was they imposed at age 72, that's new. You folks might know this as age 70 and a half. So with the Secure Act, we've changed it, we've upgraded to age 72. So the IRS said, hey, at age 72, we're going to have all of our retirees or seniors start to withdraw some of their pre-tax retirement dollars, okay? And it is a slower drip. I wish I could say it's like 5% every year. The RMD calculation is not that clean. It does escalate the percentage of withdrawal each year. And we have charts and schedules and software that can help you give you an idea. But we can't get it exact because it's always based on the ending balance on December 31st. So we don't know what you'll earn throughout the year, depending on how your retirement's invested, okay? So that's something that you would look for your financial professional to give you the number every year. But it is there so that the government gets to participate and forces you to take out some of your retirement accounts and at least pay taxes on a smaller portion. So again, at age 72, you're still under 5%, and it graduates each year as we age, all right? And if you inherit a spouse's IRA, you get to continue to defer that lump sum of money, but that will make the RMD for you personally bigger in the following years, okay? The Secure Act I want to mention as well, and it's for a different day and a different topic, but that also changes what happens for your beneficiaries when they inherit IRAs. So up until recently, up until the Secure Act, your beneficiaries were able to create what's called a beneficiary IRA or a stretch IRA. So any of those pre-tax dollars that you passed on, they were able to leave it sheltered as pre-tax. They too had the distributions, but a small percentage every year. Well, recently that changed again. And we're being told that beneficiaries, not spouses, when not eligible beneficiaries, but most beneficiaries, when they inherit the IRA, they will have to make arrangements to spend that down within a 10-year period. Again, in this case, the IRS is able to get the taxes from that account. So that's the goal. So that would drive those beneficiaries to have more discussions with tax planners, financial planners, accountants to decide when is the best year for me to take that out. If I'm applying for financial aid for one of my children, maybe I don't want to take a distribution and have that on my tax return. So maybe, they wait till your grandchild potentially is done with college in that 10-year window and takes the distribution. So again, this is about slowing it down and giving distributions or cash flow changes a little more thought. That's really what the objective is here. Okay, so here's the problem in a nutshell. The little sampler teaser that I opened up with really focused on the regular income tax treatment of your distribution. However, what happens in retirement, there's various income types that are treated differently, and there's little taxes and penalties. I don't want to say hidden, but new to you. So they might feel like they're hidden. Okay, so what our job as financial planners, what I do every day is I meet with people, couples, individuals, people in transition, and this is how it goes. Every hour and a half, I'm sitting in front of couples or individual decision makers, trying to help them navigate their next financial concern or trying to anticipate for them some items that they're not concerned about because they're not aware of. So this is what I do. And I meet with people across the desk. And sometimes throughout my 31 years, I couldn't figure things out. So I dug a little deeper. And that's how I got to this. And I'll share a little, when I get to the Medicare surcharge, I'll share a little story with you, what led me on my journey to seek out different answers for my clients. Okay. So again, if you have professionals in your life that you already work with and you trust and that know you and know how you behave emotionally, financially, emotionally, then they might be great people to reach out and say, hey, I attend this webinar. She kind of made me think, this is what I'm worried about. Show me how this plays out for me. Okay. So again, throughout the stages of retirement, some of it depends on your health, your age. There's different triggers that change our tax exposure. So today I'm just trying to give you some of those bewares and some of those, not hidden, but surprises along the way. Okay. So I talked about how we broke it up. So your pre-retirement, obviously you're starting to think about retirement, starting to get your ducks in a row. The number one question here is, the day I'm not going out the door, what income will be coming in and what will my expenses be, okay? Then we can use all different softwares and we can project the inflation impact. So how will your income grow, if at all, and how will your expenses grow? Certainly they will, because inflation's what we've been living with, okay? So those are the pre-retirement years. And of course, we try to take advantage, I call it like that last run to retirement. If kids are out of the house now, maybe you have the most cash flow you've seen in a while, you want to pack it into some tax favorable items. That's a different webinar. We can talk about that another time, but those should be some of your thoughts. Maxing out 401ks, 403bs, using those Roth IRAs. Inside the 401k, there's after-tax contributions above and beyond the $26,000 elective deferral. So again, another conversation. I'm just trying to give you some tools that you can use to help you. All right. The second part of that is early retirement. These are what I was referring to as the go-go years. So many times folks have bucket lists. They have plans. They want to travel. They want to, spend time with grandchildren, see family. All great. So when they come to a financial planner to kind of project out income and plan their income, maybe the first 10, 15 years, they want more income to spend. And maybe we know from running the plans that they can't sustain that for potentially 35 years of retirement, but certainly for the first 10 years, they're going all out. Some clients went and got a mobile home and they want to travel the world, whatever your thing is. So my job as a planner would be to help slow you down and look at the consequences of increasing the spending early on the later years, okay? Later years could be, for everybody, this age is a range. I have 80-year-olds that still ski as clients. So everyone's a little different. So it doesn't mean these are exact, by the way. So middle retirement, we talk about the go slow years. Maybe you got most things on your bucket list done. Maybe now you like to be in your own bed, in your own bathroom. I have a 63-year-old husband that already thinks that way. I don't know if there's ever going to be go-go years. He's very ritualistic. So, I laugh when I travel with my little one. But so middle retirement tends to be kind of take the breath, you pause, you slow down a little, Late retirement, 80 plus, maybe health, you have some health issues, life changes. We talk about, projecting retirement income and what you will need when. Sometimes we say it's shaped like a smile. So again, higher spending those early go-go years, little lower spending in those middle years. And then later on in life, you could have higher spending depending on your healthcare needs. And, do you want to hire people to do your landscaping, your gardening? Maybe you took joy doing it at one time and life's changed. And now you got to hire people. Snow removal is a big one up here in the Northeast. So again, I don't tell you what you need for retirement. It's your job to start to think and plan and do the work to say, this is what I think I need to live on. This is what I want to need to live on. And then I could point out, hey, down the road, we want to build in this to keep your lifestyle, to protect your lifestyle from certain risks. I already kind of hit on some of this, so I don't need to spend a lot of time on this slide. Basically, we talked about inflation already and what the right inflation rate to use when I run retirement income planning software. We can discuss it. I could tell you historically, and then you can tell me if you think it's going to be more or less. In other types of planning, like for instance, education, we always use a higher inflation number. Healthcare, we tend to use a higher inflation number. Longevity, that is a very personal item. So that has to do with your family history, and your current health. So there's no way that I should be telling you. I can tell you what the average, how long the average 65-year-old lives in retirement, okay? I have a Social Security calculator that gives people, the best 5 possible choices is the outcome when I run the Social Security software. But again, that's based on average life expectancy. Someone can tell me, shorten it, Gene, run it as if I'm gonna only be around till age 80, run it to age 100. So all this software that we have available, and I'm sure I know folks offer it online for free, is only as good as the input, the assumptions we make. So just remember that. You always discuss with people, what are these realistic assumptions? What do you think? So you want to look at these retirement risks, but you want to also get some input. Am I using good assumptions? All right. Expenses I talked about, we usually divide them into the need, have to have, your utility, your car cost, your food, your gas, And then we have the wants. That tends to be your entertainment, your vacations, your gifting to kids and grandchildren. You're helping kids with weddings and houses. You know, I've had people come in and say, I really feel strongly I want to give $30,000 to my adult child for their first home. How does that play out 5 years from now, 10 years from now? Well, I feel that. And that's my job, to rerun software and give them an idea of like, hey, this won't affect you much, or yeah, you know, this is what the trade-off is. So again, it's not my job to say, don't give that adult child that money. It's to say, hey, that impact won't show up until X date, if at all. Okay, so what's the first thing I need to understand about retirement and taxes? It's this: you have to know your after-tax savings looks like. So as we've seen recently, the IRS can change how long they let you defer taxable items, or change the status of things that we thought were helpful with our taxes, okay? So we need to get a good look and say, okay, what's the number? People say, what's the number? What do we have to have saved to be able to retire? So is it, you know, for a couple, is it 1.6 million? Probably for most couples. It depends on the expenses that you need to cover in retirement, what your lifestyle choices are. But what I like people to know is the after-tax picture. So what does that mean? If you look at your 401k and it has 500,000, you don't really have $500,000 available to you, because there's a piece of that of which will be taxable at some point. Sometimes we get to control when it's taxable, sometimes we don't, okay? But at some point, that 500,000 of that, the IRS will be knocking for their share of that, okay? Now, what is their share? I don't know, I can't give you an exact, I can tell you what the tax rates are and we can guesstimate. That depends on the tax bracket you're in when you take the withdrawal. So what I have a lot of folks doing these days, especially with these, our current tax brackets are very low traditionally when we look back in history. So currently, and as far as we know, we're safe into 2021, completes itself. That's what I've heard from AICPA lectures I've listened to. So what are a lot of folks doing with this regard? Roth conversions. So in the past, there was an income limit that maybe you looked at this strategy, but it didn't work for you. I am encouraging all folks to reconsider, to work with their accountants and their planners. Maybe you should be taking advantage of what some of my clients have named serial Roth conversions. So basically, we look at your individual income tax bracket, and then we decide to take extra money out of the IRA or 401k purposely early, not because we're being forced, but because we like the tax bracket you're in. So we want to fill the bracket. So when we go back to the example in Bill, I'll just throw that in there for you. So he probably has like 30,000 before his 22% would go to 24. So maybe he wants to take a conversion and pay taxes on that 30,000, and then that will grow in his Roth bucket, which right now is totally tax-free and has no required minimum distribution date. Okay. So again, I'm not saying everyone should run out and do that. This is something that you clearly need to do pre-work with your accountant or your tax advisor or your financial planner. But I'm just throwing around what's going on, what strategies folks are using, okay? Maybe this is not relevant for you. Maybe you know, why would you do this? Usually you're thinking about leaving money to the next generation and how they receive it. Are they going to receive a taxable account, or are they going to receive a tax-free account? So again, the big picture here is, hey, I'm staring at my 500,000 in my 401k, but I know based on a 22% federal that I only really have about 80% of that, okay? Again, this is just a graphic illustration. Depending on which tax bracket you're in, a 33%, a 12%, or 0, would show you the impact on your original amount of money and what happens as you're forced to take it out, okay? So you might say, wow, thanks a lot. I love looking at my 401k balance. This is disturbing to tell me that it's not all mine. I may owe some of it. And just remember, if you built all your 401k into a Roth, then it truly is all your money. It's after-tax dollars. It's tax-free distributions currently. But a lot of my age group, the Roth wasn't available till later in the game. And then I think from what my experience in speaking with clients is, at some point when they went to their accountant, clients were told, you no longer qualify because you didn't meet the income cutoff. So again, you made too much money, you can't make that IRA contribution. My advice is to encourage you, if you haven't asked in a while and you have extra savings, to ask again, am I eligible for any IRA contributions? Okay, so again, you have to still have some kind of earned income. and then you could be eligible to make these contributions. I just caution you not to think that 1 year you weren't allowed. Since then, the income brackets have been widened. So maybe you are allowed to make contributions. But what they're saying here is now you got different issues because your income isn't just from work income anymore, especially if you are already retired. Now it may be from Social Security, and then you have other challenges with Medicare. Okay, so we're going to talk about, there's two things here. One is called the Social Security torpedo, and the other one is called the Irma cliff. So those are our little code names in the industry. So I'm going to go back through and show you an example of couples that experience each item. Now, again, the main goal here is for you to be able to anticipate any potential changes in cash flow or any items coming out to you. The worst thing that I see is that folks don't have their withholding set up properly. So again, this is a separate conversation. But what happens is maybe with the first person started Social Security and there's no withholding. Then the second person came and they're really feeling it because at tax time, you have to come up with $3,000, $4,000 to pay the IRS. And at some point that might get a little disconcerting. So instead, I recommend, again, it's not for everybody, that each source of income have the proper withholding. I hate when clients have to pay quarterly estimated taxes. Some folks choose that for a reason, but I don't like it if it's because of poor planning. So again, my goal is, here you are in retirement. When you get your Social Security, there's a form on the Social Security website. Put it into Melinda and ask her and we'll email it to you. It's a simple form. It checks the box. What do you want withholding? It's only the federal withholding. There's 10, 12, 22%. You can check. The highest is 22, but please, instead of, if you are paying quarterly estimated, maybe you say to the accountant, is there a way that I could stop doing this? So a lot of times that's an after tax time discussion. The accountants aren't necessarily going to drill down into it during, the race to finish your tax return. But clearly this time of year for next year, let's get ahead of it. My best recommendation is assign the proper withholding to each source of income. You have a pension, let's figure out what do we need to withhold on it. Is it the 22%? Let's assign it to the pension. You're going to get a little less each month, but you won't have any lump sum surprise expense at tax time. Okay, so we're back to our friend Bill that went to the Willie Nelson concert. So here's the little bit more breakdown. And I will tell you, when we put this together, it took some of our other professionals a while to understand where we were going with this. So again, don't think you're crazy if it's not obvious to you. Stay with it. The key to it, though, the real key to understanding it is looking at your 1040. So what I did when I first was looking at this example is I created a faux or pro forma 1040 for this client. And that's when I really saw where the trouble spots are. So again, to you, I'm challenging you, like, know your 1040, open it, look at it. You pay a lot of money to get it done. Maybe you do yourself on TurboTax. Nonetheless, become friends with that 1040. To me, that's like a diagnostic tool. It's like, going to a doctor with your blood work. When folks come to me for planning, I say, well, where's the 1040? Because that helps me, that's a look right in, an x-ray that I could see what's going on behind the scenes, okay? So if Bill said to his financial planner, boy, that $1,000 cost me $400, he might not know what he's talking about unless the planner took a moment to look at the tax return. So what I'm suggesting is that you use that. We call it a pro forma. So a lot of the software I have, Income Solver and some other ones, we take what your 1040 looked like last year, and then if you want to take out $20,000 and fund a wedding, good for you. Let me show you how it plays out for next year. Okay, so assuming the tax code hasn't changed or the new software hasn't built in, this is what will happen. So again, this is what happened with Bill. Now you should be able to follow a little bit of this. If you get confused, I'll break it down further after the fact if you like. So we said his IRA income was originally $38,000. He's circled in the red. And then we went over to the other column. He took $1,000 more of his IRA out. Good for him. That's what he saved it for. It became $39,000. His Social Security benefits that year did not change. He had $25,000 the year before. He got $25,000 this year. Maybe there was a 0% COLI. So his AGI, which if you don't know what your AGI is, it's on your 1040. Open it and look. You kind of should be familiar with that number, okay? I think we get lulled into not looking at it. So this example, it was 56,000. By taking out the 1,000, that jumped to 58. That's the culprit. It didn't jump to 57, it jumped to 58. So I'm going to explain to you why in a minute. So his income tax rate did not change. His income tax he owed, instead of $5,000, $5,456. This is how we were showing you the $400 escalation in income tax. Okay, so how is all this happening? What's going on behind the scenes? It's one of those hidden taxes that maybe you're not aware of. So it has to do with the Social Security tax torpedo. Here goes. So Bill, what happened was he tripped that Social Security tax. And by going over a limit in his taxable income, he caused more of his Social Security to be taxable. That's how we went beyond the 22% impact, because now more income was brought to the table. Instead of just the extra 1,000, it was over 2,000 more of income. That's why the 22% was doubled, because it was on more income. Where was that income before? Bill was getting it. It was Social Security income, but he didn't have as much of his Social Security taxable. So I just want to unpack that for a minute, because this part is important for everybody in every bracket. So when I started 31 years ago, I had a couple in front of me. They were arguing about how much money they could take this year out of their IRA. You know, the woman wanted to do some traveling and the man did not want them to go above 32,000. I was new and green, didn't know what they were arguing about. Didn't get it. I was taught, keep quiet when people are arguing in front of you. That's what I did. Later, when I did the homework, I realized what they were alluding to. Why I'm telling you this? Because it's all these years later, and these numbers have not been indexed. They have not been upgraded with inflation. So these are the same numbers that I remember learning all those years ago for you folks. So these are the numbers, and I keep a little, like a little tax cheat sheet. And if you would like one at the end, I'll be glad to email it out to you via Melinda or Bruce, okay? So what this shows me is that, again, and these numbers have not changed. When we tax your Social Security, when the IRS taxes your Social Security, they look at what's called your provisional income. And again, if anybody wants to go deeper, I'm capable of doing that with you. I don't want to hold the rest of the attendees hostage, but I just want to tell you that the married filing jointly cutoff is $32,000. So we calculate this provisional income, which is the little weird calculation. It's not your regular AGI, and I'll explain that in a minute. And for a couple, it's $32,000. For a single person, it's $25,000. So here's the rub, okay? So in order for you to keep 100% of your Social Security from being taxable, you'd have to have provisional income less than the $32,000, or for a single person, less than $25,000. What I'm saying to you is it's very challenging in my experience in the Northeast to be able to live on, because of our expenses between heat, snow removal, property taxes, if you own a house, it's very challenging for most folks to avoid paying any tax on their Social Security. What happened to Bill here, he tripped the wire and he went from a 50% tax up to more of a taxable. So what does that mean? So if you were staring at your 1040, it says Social Security benefits. To the left, it counts all 12 months. In the column that they add up towards your total income, right? It may count 0 months. It may count 50%, which really is 6 months. That 1040 may count 85% of your benefits, which I've changed to 10.5 months. So follow me. All of us, no matter what our income, we get a month and a half of free Social Security as far as not taxable. Woohoo! Okay? But somewhere along the way in that provisional income calculation, decisions are made if 0 taxable, 6 months are taxable, or 10.5 months, or someone in between. Okay? And that flows over on your 1040. So that's important. And I'm not so worried about you finding out the exact amount, but you should look at your 1040 and say, how much do I pay tax on? Now, when I originally started doing these webinars 14 years ago, all right, folks would say to me, 85% tax on my Social Security, and they would leave very upset and talk to their neighbors, and the neighbors were calling me. No, that's not what Jean's saying to you. I'm saying to you that this is why I changed it, that 50% of your benefits could be taxable at your income tax rate. So for Bill, his income tax rate was 22%, okay? Now, maybe for me, it would be 85% of my benefits, so 10.5 months will be taxable. So I challenge you to look at your 1040 and say, okay, as of last year, here's where you will see 12 months of your household benefits could be for husband and wife both in there. How much of that was carried over? You're probably going to see 85% of it became in the taxable column. And then at the end, your income dictated what percentage you fell in. This gentleman, he fell into 22%. So it's not by accident that we thought it was only going to be 220 and ended up about 400. That's because slightly more, a couple more months of his Social Security became taxable too, all because he went over this limit. And it's like, boom, you hit it, and then it changes what's included in your taxable income. That is a lot of info. So again, my goal wasn't to make you tax experts. My goal is just to hear a little warning sound. Hey, I want to take this distribution. Let me run it by. I found that it's challenging to get the accountants sometimes to slow down and run these pro formas. Be persistent. Be willing to talk to them after tax time, depending what the rest of their business model looks like. Hopefully they'll give you time. Maybe you have to pay them for an hour. I just realized that surprises to cash flow in retirement when you're on a fixed income are brutal. Even if you have a backup, it's uncomfortable. People like predictability and manageability, especially on their cash flow. All right. It's bad enough that health issues might hit that. But in the meantime, let's try to keep things predictable. So that's my advice on this. This gentleman, Bill, took $1,000 and it cost him $407. Maybe he still would have made that decision, but he definitely didn't know it when he took the money out. Okay. And most investment people, like if you called up and said I needed $1,000 for my IRA, they wouldn't go down this road. I mean, I started out as an investment professional in my career. I still manage investments. This is not necessarily where you would go early years. I wouldn't have thought of it. Again, I had a client. When I learn lessons from clients, I put it in my practice to help other people avoid those situations. So it depends who you're talking to, but I want you to know what triggers what so that you can get in front of it. All right. So I know at the end in the questions, there's going to be questions on this, and that's fine. And I will stay around and answer them. I try to get it concise to hit the heart of the matter. The heart of the matter that is in the income tax bracket world, Bill knew it was a 22% thought, but because it made more Social Security taxable, it took that 22% and applied it to additional income that Bill was not expecting. All right. That's the short form of it. Woo. Okay. So here we just stop a moment to discuss different retirement approaches. Some folks retire completely, boom, done. They know they're done. They don't look back. Some semi-retire and work part-time. I've had people go to landscaping. A couple became master gardeners, like whatever your thing is. Some worked in bakeries. So some people volunteer. Sometimes they get paid even though they don't want to or need to, but that's the requirement of the 403B or nonprofit. Some just take up hobbies that cost money and don't make them money. I've heard that. Beading, putting together jewelry. Some spouses complain about. I heard golfing expenses. I've probably heard it all. But again, everyone plans a little differently. And I want to talk a little bit about how that affects Social Security. So this other item I'm going to start speaking about right now is one of the number one questions I get from folks. So folks say to me, what's that number, Jean? So when we talk about the number here for working and receiving Social Security benefits, this number does get indexed and increase every year, which is good for us as taxpayers, okay? Some say it's not increased enough, but it is. So for 2021, the number we're going to be talking about is $18,960. What is that number? That number is the amount that you're allowed to make if you are receiving Social Security and not full retirement age. I do a whole separate webinar on Social Security. I took this out and put it with the tax piece. Because again, I don't know how much of you out there have investigated Social Security or Medicare, who's on what already. I just want to tell you generally that there's good and bad to working later and how it affects Social Security benefits. So for those of you that don't know, Social Security is based on your highest 35 years of earnings. So why do you care? We don't like to have zeros there. Many times it is caretakers, folks that were home either taking care of kids or taking care of parents that maybe don't have 35 years of a work record. So you have zeros in there. So if you work later in life or you get a part-time job later or you semi-retired, the income might actually improve your Social Security. So follow me. You could be getting Social Security checks. Maybe you ran and signed up at 62 because you thought that was best. Again, I would use my software to tell you what the impact of that was first. But so if you signed up at 62 but wanted to work or needed to work, that working at below the full retirement age, which most folks out there that are coming into retirement, it's usually like 66 and 6 months, mine is 67. Who knows if they're going to increase that later on for the next gen? We'll find out. So if you're doing that, you might be growing your future Social Security. So follow this. Every time you get a paycheck, taxes are taken out towards Social Security. That's done automatically. If you're self-employed, you're supposed to take care of that at tax time with your accountant, okay? So if you're getting a Social Security check and you're still working, hey, this could be good news. You're still putting in the pot. Yes, you're putting in your pot of money. Will that affect your check in the future? It depends. Is that new income higher than other 35 years? Absolutely. Then your future check will go up, okay? Maybe you're working and you're still putting in the pot and your check's not going to go up, okay? Because you already had your best 35 years. So what I remind people, if folks still have pensions out there, you're trained that the final 3 years, your final average salary is the big deal. Get that overtime in because your pension's based on, usually the formula is 3 years final average salary. Social Security is your best 35 years. They don't care if it was right out of the gate you worked the hardest and then you raised a family. I don't know, but it's your best 35 years, okay? So earnings after 62 may increase your Social Security, but they may not. So that's what we're calling the good, the bad, and the ugly here. All right. Now, Social Security early and continue to work. This is that number that I'm speaking about. So for those of you that are above your full retirement age, if you're older, it was 65, it could be 66 in 6 months, 67. Your job is to know that. It's on your Social Security statement, but it's also easy enough to Google, honestly. So here's what I could tell you on this. If you're working and you're below your full retirement age, I used to call it a penalty and I kind of got yelled at, Social Security admin, it's a temporary reduction. So here's what they tell me. For every $2 above that number, which is $18,960 for this year. So say you say, I'm going to get my Social Security early, I'm going to collect at 62. I don't know if it's going to be there. That's what I'm going to do, but I need to work for extra money. Be careful. And I'm not telling you not to work. I'm just saying once you go above $18,960, for every $2 above that, you give back $1. Let me give you an example. Have a bus driver around November 10th. He says, see you, Gene, after the holidays. I said, where are you going? You all right? I'm fine. He says, I'm at that number, so I don't need to work anymore this year. So doing what I do for a living, I understood what he meant. We've had tellers when I worked in the credit union for the 20 years that they would work up until they made the $18,960, and then they would say, I'm taking off the schedule till January. Why did they do that? Because let's use an example. Say you made $38,960. All right, and you're getting Social Security and it's $2,000 a month. What would happen? You went over the $18,960 by $20,000. You owe the IRS back half of that. So you owe them 10 grand. Where are they going to get it? Nope, they don't expect you to send them a check. Remember, they're giving you money. They have control over that check. What you're going to notice is 2 years later, January would come and all of a sudden you don't get your $2,000. Like what? Go on Social Security, must be a mistake. It didn't hit my bank account, blah, blah, blah. Oh no, sir. You made 38,000 2 years ago. So now we're going to dock your check. So January, February, March, remember they're trying to get it back 10 grand. You make 2,000 a month. You won't see a check till June. Now, maybe it's still worth working, but I would hope that you would have known that in advance. Maybe you don't need that 2,000 because you got a great job that really captured your interest and you're earning more. Okay, but I just wouldn't want that check to stop and you weren't expecting it. We don't want. We want to avoid that. Okay. So with that being said, pay attention if you're below full retirement age, and unfortunately, I can't just blanket it at 65 anymore. So you need to know that age, and you are receiving Social Security benefits already, and you choose to continue to work. And I'll say one more thing on this. This causes anxiety for widows and widowers, because as a widow or widower for survivorship Social Security benefits, not retirement, survivorship, you actually have the privilege at presenting at age 60 to Social Security. You don't have to wait till at least 62, but you're still held to this rule. So many times, unfortunately, sadly, I've seen this isn't enough. Receiving their deceased spouse's Social Security benefit is not enough to pay the bills, and they still have to work, and maybe $18,960 isn't enough to earn. So sometimes that puts a wrench in the works. If you're, and I'll just caveat this, if you apply for Social Security survivorship and you have dependents in your household, no matter what your age is, or you still get a check. This rule applies, but they would get a check as well. Okay. So I'm not saying that Social Security doesn't help people because of death, but it's not as helpful as you might think. And any friends that are widow or widower between 55 and 60 will tell you this. In life insurance training days, we call this the blackout period, because what that typically meant was there was no longer dependence in the household. So there you have a spouse that if one spouse dies, Social Security might not be helpful yet for them, or they might have to work while they're getting the benefits and might not realize that they'll give back some. And I just want to slow down a minute and go back. So why 2 years later? Because Social Security admin and the IRS are working on your most current filing. So not everybody files on time. So generally they went back 2 years. So for 2021 this year, they'll be looking at 2019's tax returns. That's important, and I'm going to come back to that. So when you read that, if you go back and read something, or you want me to, actually we have a great handout we'll be sending out, and you'll see it in there. Just remember that 2 years isn't by accident. It's just giving folks leeway time to get caught up on their filings. So that's why the Social Security admin uses that number, the IRS ultimately. All right.
Excuse me, Jean. I
Yep.
just want to let you know that we've got about 5 to 7 minutes left.
You got it. So
Okay.
I'm going to forward away from Social Security then. I think we've hit everything on here, and we're going to talk about a Medicare pitfall. This one is extremely important, so I want to make sure I cover it. And I will stay around and answer questions later. And just to go back a minute, we talked about 4 different tax traps throughout retirement. When we discussed this, Melinda, Bruce, and I, we purposefully only did 2, because in the past, when I'm doing this, I get so many questions, and I think that people start to glaze after a while. So I wanted to focus on just the Social Security concerns, and now I'm going to switch to the Medicare concerns, okay? So for those of you out there already getting Medicare, you know that, or those of you planning retirement, you need to know this. When Medicare comes, you are going to pay for Medicare Part B. Now, whether or not you have to buy a supplement, the Medicare Advantage, you know, we sell the supplements, all that, you can speak privately to a Medicare professional, okay? But everybody that's on Medicare will pay the Medicare Part B. There is some forgiveness for lower income. I don't want to get into that. That number also is indexed every year. So for this year, I'm looking at it, it's actually $148.50 at the lowest income tax range. Got it? Now, this number does get upticked every year. I think last year was 144 and change. So they're not big increases, but they do get indexed up. This is why sometimes you hear folks mumbling about, yeah, Social Security gave me a cost of living increase, but my Social Security check isn't any higher. That's because the Medicare tax, the Medicare cost, Medicare Part B, comes out of your Social Security check. If you're not receiving Social Security and you just signed up for Medicare, quarterly you have to send that money in. So unless an employer or somebody else doing it for you, you usually have to send the check quarterly. Heads up on that, because I wouldn't want your coverage to be in jeopardy. So pay attention. Later, and we won't get to a lot of it because of the time constraint, there's also a fee for not applying to Medicare at 65. Just think that, you know, our system is built on everybody participating. So there is a late penalty that's a percentage of that 148 that stays with you all through your retirement if you don't present to Social Security to Medicare via the Social Security office on time. All right. So just keep that in mind. If you are still working or you have credible coverage as an employee, then don't worry, you won't be subject to the penalty. But I want you to know there is one. That's in one of the later slides. All right. So the big thing I want you to know here, and we don't need to go through the full example, but I want you to know that that 148 is income driven. So it goes up the more income you make. So I'm going to give you the lowest cutoff. For a single person, it's $88,000. There's a calculation of a certain type of income, a little different than the than the modified adjusted gross income. All right. Now, for a couple, it's $176,000. I'm going to skip this example and go right to the heart of it. When do I see people get blindsided by this? And remember, it's usually 2 years later that it comes out, that you get a little letter from Social Security that you get annually and says, here's your benefit for the year. We had a little cost of living adjustment, or we didn't. Some years are 0. By the way, here's your Medicare Part B cost. And if you're lucky enough to get it covered by an employer, usually government employees, then you send that into your employer to let them know that number went up this year. More is coming out of your Social Security, and those folks get reimbursed quarterly. All right. So, but for the rest of the world that are paying it from their Social Security and no reimbursement, I want you to know that there's triggers. So that first hurdle for a single person is 88,000. The next, and let me actually show it to you. Here it is. The next is $111.01. And then for a couple, it starts at 176, goes to 222, all the way up. Why is this important? Because the base is 148.50, But as you show more income on that 1040 from 2 years earlier, these go up for the whole 12 months. I learned about this by accident, but I'm here to tell you that in my experience, if your income goes back down after the 12 months of paying more every month for your Medicare Part B, it will be promptly reduced. You can also fight this. I had somebody recently, his income changed dramatically because he lost his spouse in November of last year. So he was supposed to pay this for this year, and we petitioned them. There's a process, there's forms. Let me know if that's your case. I'll show you where to find the forms or email them to you. And we petitioned Social Security, SSA, and said, wait a minute, he just lost his spouse and lost the pension. So his income's going way down. You know, can we waive this? And they did. So you can appeal it, is what I'm trying to tell you. So when do I see this happen to clients? Usually it's because you sold something like a second home. Your primary home is not on the table, but it's the second home. It's a portfolio. I stumbled into this in 2007, and I didn't know about this then. And this is how I learned about it. I pulled clients that were very nervous out of the stock market in 2007. I thought I was the hero. You know, they prevented a 20% reduction for the next year and a half, right? But what happened was that capital gain changed their tax bracket. So for a whole year, his wife and him each paid double that 148.50 for 12 months. Yeah, they could afford it. We made nice money in the stock market. It's not the point. The point is they were blindsided. I didn't say to them, hey, when I do this, this is what's going to happen. All right. Recently, I had that gentleman take money out to pay for his daughter's first house. And I told him, hey, your Social Security is going to go up from 148 to 207 for each of you. He didn't care. When he did the math, yeah, an extra 100,000 for 12 months, $1,200. We still want to do this for our daughters. Great. So at least in 2 years from now, he's not blindsided. He realizes. So that's what I want to just make aware to you. And I'm going to defer to Melinda at this point. Those are the two most important ones, the Social Security situations and the Medicare. Thank you, Melinda.
Thank you so much, Jean. And if you don't mind, we've got some questions. The first is, what if one spouse is collecting Social Security and the other is still working full-time, filing jointly? Is Social Security maximum based on total AGI?
So when you say maximums, there's two things I'm thinking about. One is working and receiving Social Security. That's very individualistic. So even though you're filing jointly, they will look at it as the individual in the household. And quite honestly, that's why some houses, if you're self-employed, they might work with the accountant and give more responsibilities and more income to the spouse that's not receiving Social Security. So absolutely, as far as working and receiving Social Security and not having that reduction, it's very individualistic. As far as income tax and paying taxes on the Social Security, it's very much a joint conversation. Okay, so things you could do to try to reduce that income, try not to have capital gains and like unwanted capital gains and dividends hitting that tax return. So those are some things you can change within your portfolio. But those are great planning opportunities. Try to get in front of it. Go ahead.
Thank you. And do you have any general guidance about whether to take Social Security at 60 or 62? Is it a good idea?
So again, if you're a normal retiree, the first time you're eligible to present yourself at Social Security is age 62. And I do a whole separate Social Security webinar, which I would love to share with you folks, because there's if you were married more than 10 years or currently married, there's 2 buckets of money you get to choose from: your own work record or half your spouse's. And there's some interesting rules, which we do not have time for. So what I would tell you is, sometimes people for health reasons want to run at 62 and sign up. The answer really depends on the rest of your income, because that will determine the tax treatment and how the Social Security is treated. Okay. So I usually back into that, Melinda, by running a retirement plan. And then after you see your retirement income plan, we could do what ifs. What if I turn on Social Security 62? What if I wait? The last part of that is, and this is not a full Social Security discussion, there's survivorship for Social Security. So sometimes I have one person, the primary income person, I say they take one for the team. They put off taking their Social Security till age 70, because this way they're growing it. There's delayed credits, 8% a year. They're growing that Social Security so that if one person passes, you keep only the highest Social Security. The lowest Social Security always leaves the household. So there are reasons to wait beyond, worrying that Social Security is not going to be there. So I hope that answers the question.
Thank you. We've got another one. If you are a child inheriting an IRA, I understand you have to deplete it within 10 years, but do you need to take yearly RMDs, or can you take it in one lump sum in year 10 without penalty?
Exactly. The understanding is excellent. You could take it in year 10. The RMD was with the old style. So if the death was for the Secure Act, then that beneficiary is tied to the old style with the RMDs. The new style isn't as favorable in some aspect because at some point in the 10 years, the child has to take that money out and pay taxes. So again, great planning opportunity. Maybe it is year 10. Maybe it's a year where one of the spouses retired and the other's still working and you were used to paying tax on that income. Maybe you take money out. So, and those aren't eligible for the Roth conversions, unfortunately. A great question.
Thank you. I think that takes up our time for now. And I just want to thank you very much, Jean. This was amazing, informative, and I've got a lot to think about. Also, just to let everyone know that this will be posted on the seniorlawday.info website. The materials, including the tax cheat sheet, will be posted by Friday. And thank you again. I turn over to Bruce now.
Okay, Melinda, there is one more question in the chat that we may not.
Oh, sorry, I missed it. Oh, okay. It actually says, you may want to share this with other listeners. My husband became Medicare eligible while I was on COBRA. I mistakenly thought I could still cover him on COBRA, and he subsequently was hit with a Medicare penalty.
Exactly. So thank you for sharing that. Yep, there are individual rules about, when you present.
Right. And then the other question was that someone's turning 72 in October. They want to know when the RMD has to be taken out.
So it's the year in which you turn 72. So if it's October of 2021, it has to be taken out in October. Some people use this as planning, but there's a grace period. That is still there. We know it from the age 70.5. The rule is, it was meant that if you were to miss it and you get to do your taxes next year, you get to the accountant and they pointed out, you could take 2 the following year. Sometimes planners use that as a loophole for certain reasons, but generally the rule is the year in which you turn 72, the distribution has to get taken. If you miss that, there's a grace period up to April the next year, but you would take 2. You take the one you missed before April, and then you have to take the next year. So you're going to end up paying anyway. You have to figure out, is that a loophole you want to go through, or don't bother, just stay with the traditional.
Okay. Then Jean, if you could stop sharing your screen for now.
You got it.
Well, thank you again. And I'm just going to take a moment to direct you to the Senior Law Day website, which we didn't have, just to connect back to what Melinda was talking about, earlier. This is where you can go next Tuesday to register for consultations. I wanted to also just take a moment to thank our sponsors, and hopefully it was a little slow right here, but you can see here we have sponsors, attorneys, financial planners, geriatric care managers, and other organizations like the Dreyfus Foundation and Westchester Library System. So that is what has made this all possible during this time when we've had to go remote. Okay, well, thank you very much. And I'm going to end the webinar right now, and everyone have a great day.